Good evening, everybody, and welcome to the October edition of our Economy, Markets, and Investments Update. Let me take you through in our usual sense. Just a heads up, while we generally try to cover the economy, markets, and investments all in equal form, this time we would probably spend a little bit more time on the markets aspect because of what's been happening and a little less on the economy side. So to kickstart this, let me just pardon me. Yeah. So, as you're aware, you would have seen this slide from earlier presentations, right? The stock market essentially delivers returns to investors through an economy's performance related EPS growth expectations from stock market companies. So, the actual earnings forecast is discounted by the market and delivers value to you as and when that forecast changes, the share price changes, and you make money off it. So that's how the stock market delivers returns. The other thing which happens is that independent of the economy performance, there's a demand and otherwise for stocks in the market, which is essentially a function of what alternative options do various investors have other than investing in the stock market. And that's a competition to that. And whenever that competition takes money away from the markets, you see price erosion. And when money flows into the market because others are not as attractive as investment options, you make returns. The main sources of these are obviously from foreign investors, which are known as FIIs or FPIs, and the other one from domestic investors, which cover a range of investors, right from retail participants in the equity markets to HNIs, to mutual funds, to insurance companies, and the like, right? So there are varied performers here. So coming first to the economy aspect, like I said, we'll spend a brief little time just to let you know that the macro aspect of the economy is that private, if you see the Q1 GDP numbers which got published, the economy grew at almost 8%. It's a very healthy rate of growth, driven from mainly from a private financial consumption of 6% and capital formation largely driven by the government of 8%. If you now look at a sectoral breakup of the GDP, you can see that services, notably finance, real estate, and professional services, as well as public admin, defense, and other services, have driven the economic growth, while industry has done middlingly well at 5.5%. Agriculture has maintained about 3.5% rate of growth. Right. That being said, overall, to summarize, it's a services segment which has broadly held on to the growth, with private consumption improving a bit and investment, the private sector still seeing some softness. And you will see that these are the two which have helped grow our GDP strongly. The way to look at the markets is also that the market is always forward-looking, and hence when you look forward in terms of the next quarter or the following quarter, it is the PMI, the Purchase Managers Index, which gives you a very good indicator. Generally, it's perceived that if this indicator is trading above 50 and is on a rising trend, it augurs well for the economy. So you can see both the manufacturing and the services PMIs have been on rising trend and well above 50. This augurs well that the coming quarters GDP growth will also be at reasonably good levels. How does this GDP growth that we're talking about translate into earnings of stock market companies? From the previous quarter's earnings, you can see that overall, the green is where we've seen a sharp increase in YOY earnings. But by and large, overall, the market has seen almost a 50% earnings growth, of which large caps are about 63% and non-large cap 31%. However, if you remove financials from this, you'll see that about 22% growth from large caps and 8%, overall 17% earnings growth. So which ideally should translate into stock market returns. And the expectations for the coming year, 23-24, is also that it will hover around the same 17 to 18%. So it indicates things being on a good wicket as well as Indian economy is concerned. Moving quickly to the markets, this good economic news, how did the market react to it? If you look at it, the falling demand for stocks versus that, and then go back a little bit in time. I'm going back to almost more than a year ago to June 24. The last time the market was completely in red zone. Because if you can look at it on the right-hand side table, FIIs had pulled out about 100,000 crores from the market in the 3 months preceding. Right. Since then, however, FIIs have been net investors in our market, and except for a brief period in the second half of December, when about 3,000 crore of FIIs selling was there. So the second half of last year, from 30th June onwards, FIIs have been fairly continuously invested in the market. The last 15 days of December is typically accounted for the fact that many hedge fund managers tend to book cash profits in order to receive their bonuses and the like. But the year began with a 30,000 crore outflow just in 1 month, primarily driven by the Hindenburg report, which came on Adani, followed by the next month, that Silicon Valley Bank and other banking related crises. So these two affected FII flows to some extent. We had about 34,000 crores going out in those 2 months. And as you can see on the left hand side, that's what turned the markets from full green to green first 1 month and 3 months, then even the 6 month return turning green. And by March, this process had led to almost the 1 year returns of the broader market turning into red. So you had a first quarter which was not very good from a stock market return perspective. It would have been much worse if not for the continuous buying by the mutual funds here. Thanks to investors who had given money through distributors to mutual funds, we found that quarter to date, from 1st Jan to then, 50,000 crores of money had come in from mutual funds, thereby protecting the fall. Otherwise, the fall could have been much worse. So we had a last quarter of the previous year, which was by and large positive. Next, we had a first quarter which was negative. And then from the new financial year, you're again seeing the markets in green driven by the return of the FII flows. So you see the first quarter, June 28 ended quarter, 80,000 crores came in from FIIs. Then in the month of July and August, again, it's gone up to 58,000 crores. September is when we again started seeing a month-to-date outflow. Though net for the quarter, it was positive. This overall quarter positive means the markets remain positive through this period, but the impact from September that FIS has started withdrawing money came in and has started affecting our returns now. So you see, as of October 3rd, you already saw the 1 month returns turn negative, both for the small cap and the large cap indices. And as we follow through the month, we expect this pattern to repeat because FIS selling is continuing. Well, why does this happen? How to explain the market's volatility? So the answer lies in the ownership and the buying and selling pattern in the market. On the left-hand pie chart, you can see that 43% of the stock market capitalization is owned by the private promoters of the company. So they obviously don't trade in their stocks as much. So the balance 58% is what we can consider as the free float, which is given on the right-hand side. And as you can see in that, it's a fairly wide spread, except that FIIs account for 1/3 of the free float of the market and mutual funds another 15%. So between FIIs and mutual funds, almost half of the market sale and buying is controlled. So since this is a limited set of fund managers who are dealing with it, we'll focus on this to understand market volatility. And one of the key things here is our market is among the most sensitive markets to foreign flows in the world. We are the fourth most sensitive market after Taiwan, China, and Brazil. And if you now look at the component of the FII flows, since that's the largest pie, you will see that on the left-hand side in the pie chart, sovereign wealth funds and insurance funds are generally, quarter of the flows are generally longer term. So the short-term volatility that you saw in flows is entirely accounted by the mutual funds and the hedge funds, which tend to buy and sell from a much shorter time perspective. With there, when you look at the mutual funds, a large segment of mutual fund flows are all ETFs, which are called passive mutual funds. And you can see in the pie chart here, India today of the passive index, MSCI Emerging Market Index, accounts for 15% of the allocation. And this 15% is a result of almost doubling over the last 3 years. So you can see that passive allocation to India has been increasing. And as the flows have been increasing, this is unlikely to have been causing the volatility. Then what then causes the volatility is the balance of the 68%, which is mutual fund and hedge fund. A portion, as I explained, was the passive. The active mutual funds and hedge funds tend to be much more sensitive to short-term news around India in terms of putting in money or pulling out money. What is this? The main sense of this FII behavior comes from the fact that India as a country is probably one of those single largest big emerging market economies, which is heavily dependent on imported oil to finance its country. So here I have pointed out 8 such factors. Whenever oil prices tend to rise, money tends to flow out of India because these are the negative impacts they anticipate. And in the next slide, whenever oil prices tend to go down, these very 8 factors which were negative turn positive. So a significant degree of the volatility of FII flows into a market can be attributed to actions by active fund managers and active hedge funds when they see a strong trend in the price of oil. The evidence for this from this graph, where in the bottom, the line chart is actually the price of oil as it has moved over the last 3 years. And the top is the FII flows. And those arrows match the pattern of the flows to the rise or the fall in the price of oil. So as you can see, the period of declining oil prices, which started from COVID, saw a huge set of flows for 6 quarters. Then when oil prices started rising with the impending Russia-Ukraine war, you saw that for next 3 quarters, if has pulled out a whole lot of money. Then the US announced the Fed rate hikes, and hence it was perceived that the economy would go into slowdown and oil prices would come down. So from after hitting a high of $125, they dropped close to 80, and in those declining oil prices, FIS made a comeback. There was a blip in Jan, Feb, March, partly attributed to the Adani factor, as I've written there. And then when you saw stable oil prices, you saw in the first quarter this year, again, FIs have come back. In the second quarter, they have come back, but the month-to-date number being negative tells you that most recently the oil prices have started rising. So as you can see now, there's a clear correlation between FII inflow and outflow with oil price decline and increase. So in terms of judging a shorter-term assessment of the market, and in fact, this month-to-date 15,000 crores in September clearly can be attributable partly to the rise in the price of oil. Right. So now when you see here, however, through the graphs, you've seen that always domestic funds have been mostly behaving contra to the foreign funds. So this table splits up those FII flows, this time written in thousands of crores. You can see during COVID, because of the low oil prices, when FIs put in money in the top declining, domestic investors were sellers because people were panicking due to COVID. They didn't know whether the economy would recover, so they were pulling out money from mutual funds, and mutual funds had to necessarily sell. But from April 2021, the reshaped recovery in the Indian economy, the fact that bulk of COVID was behind us, meant that domestic investors' confidence in the stock markets improved, and for the next 2 quarters, both FIIs and domestic investors were buying. And then when rising oil prices happened, is the FIIs were sensitive to rising oil prices, not domestic investors. They are looking at the good economic news and everything, and hence their buying has been consistent right through oil prices. So the volatility, which could have been much worse with the FII selling, was actually dampened down by mutual funds buying and creating a kind of a bottom for the market. And when stable oil prices, this got further enhance, the markets touched lifetime highs because now the FIs had come back, but domestic investors are continuing to buy. So the combined double dhamaka, if I may say, which is about almost 3.6 lakh crores, 2.3 lakh crores from FIIs and 1.3 lakh crores from MF put together took the market to lifetime highs. Now what are we saying? We are saying that rising oil prices again had started leading to outflow, right? So if you see the net gap in the market is about 42,000 crores between money which was already present here, which went out, which can potentially come back. Because as you can see, over a period of time, oil prices tend to rise and fall, and hence fund flows from FIs will also tend to rise and fall. So if oil prices are next going into a falling time, which we expect perhaps say March or April, like it happened this year. What is the reason this March or April happens? Is because during this period, right now, we are at the beginning of winter in the United States and in the Europe. So their oil requirement, in addition to industrial requirement of oil, shoots up because of heating requirement of oil for their homes. Right. So typically this is a time when oil demand exceeds supply significantly and prices tend to rise. So we can expect volatility in FI flows during this period. Then come March, what happens is the winter slips into spring and then on to summer. Then demand for oil drops and you generally see a softer oil base. So like if you go back over the tile and you see from April, May, June this year, money started flowing in again. So I think you can expect a repeat of the pattern from April, May, June next year. But how much money can come back is driven by how much money went out in this, because these are all short-term flows. So already there's a pool of 42,000 crore built up in terms of money that can come back. As we will continue to see some more outflows, this 42,000 will probably go up to even past 100,000 crores. And come March, depending on how much has gone out, you can potentially expect a reversal of FI flows and some FI flows coming in and taking. So from a view of the market, as you can see, it's claiming that the next few months are going to be volatile, after which there could be good news. So the other thing which has helped the volatility of the Indian markets is that the average investor, whether it's an FII or a domestic investor, has lengthened their period of time that they stay invested. That is, the short-term investment component is coming down. The longer term is going up. So that's why the average holding period from about 1.25 years is now up to almost 3 years, right? So as a result of it, the VIX, which is called the volatility index of Indian market, is much less than the volatility of the global market. So clearly, domestic flows have helped in creating this kind of a calmness to the domestic market despite what's happening in the overseas market, right? So based on the fact that these monies have been now coming in till the month of September, valuations have tended to risen, and there's been a lot of conversations around valuations, which we shall now go into next. So if you see here, the FII holding of 33% of our free float market cap is not a new feature. It's been hovering between the 30s to the 40 percentage right from 2006 onwards. So we've been a consistent favorite of FIs who every single year, as you can see in this chart, have been putting money into India, except for 1 or 2 years. And hence, we've always been trading at a premium in valuations to both the world market in dark blue and the emerging market in light gray. You can see we've always been a premium market, and this premium has at the bottom, worst case, also been at an 8% premium. So we have always been a premium market. And compared to emerging markets, compared to emerging Asia Pacific or to the world, India remains a very much market in demand. Hence, the valuations are higher. Right. However, if you turn your attention to our valuations compared to our historic average valuations, there is a 1 year forward P ratio. The red line in the middle of the graph tells you the long term average. And as you can see at the very end, our current market large cap is trading exactly at the long term P ratio. So if you look at it from a historical perspective, the markets are trading at fairly reasonable valuations as per this chart, right? And one of the things which comes up is the earnings yield gap, which is your G-Secs are giving 7.5%, but your stock market, which is 1 by the P, so the P is 20, 1 by P means 5%, right? So there's a gap of about 2.5% between the government security yield. And so people sometimes say, from a valuation perspective, if you can get a government security which is risk-free at 7.5%, the stock market should be delivering a better return. It's not. But please don't get carried away by this, because this represents a static picture as of today, because stock market is always looking into the future, and hence the future earnings growth rate are expected to deliver those returns. So don't look and say that today's P ratio is what are going to earn forever. Whereas with the GSEC, if you invest till the maturity of the GSEC, that's the return you're going to earn. So it's about a guaranteed committed return versus an invariable, non-guaranteed, but potentially variable and maybe could grow very high. So you have to always look at, is the market going to discount very soon the good news or in a much longer time frame? That's how we should read the valuation chart and not just look at it from a commonly used chart. That's why I brought it up here, right? The other thing to see is that the market, because of the flows, have been rising in valuations, but the earnings estimates of for next year or the year after have by and large remained the same at around 1077. So I think one of the key things to remember is that the market is expecting a sharp uptick in the future beyond the year 2025. Right now, turning our attention away from large cap, you can see from the mid caps that the mid caps have already rallied much more than the Nifty. This is the comparison of the mid cap rally versus Nifty. And if you take the mid and small cap composite index also, it's grown at much faster. Now, when you look at it from a valuation perspective, you will realize that this money flow into mid and small caps has actually taken the valuations of NSE mid cap at a 10.7% premium to the large cap and the BSE small cap to 11% premium. So clearly, from a 1 year forward P perspective, mid and small caps are trading at higher valuations than this. What is the reason for this? We shall look at that much later. But right now, it's about expectation of future earnings. Because current earnings, if you see, there's not that much of a difference between large cap earnings and a mid cap earnings and a forecast small cap earnings, right? So one of the reasons why is this money flow come in is because mid cap flows, FIIs who historically have invested in large caps only in our market have now suddenly found that there are a lot of investors willing to take a greater degree of risk in India, and dedicated India mid-cap funds have seen something like a 40% of the total dedicated money has come from mid-cap funds. So FIIs have now started buying our mid-caps. That's one of the reasons why mid and small caps have rallied. The second is that when FIIs are buying, and the mutual funds have to sell, somebody has to sell for somebody to buy. So when they sell, the liquidity that gets released from the mutual funds tends to get reversal into small cap and mid cap. And hence, because of their lower floating stock, right, for mid and small caps, their free float is much lower than large caps. The same rupee amount of money shifting from large cap to mid cap will make a much bigger price differential in mid cap and small cap as compared to large cap. So These are the two main factors. First is mid-cap FII closing, and second is domestic fund manager action because valuations in large cap are rising. And the third aspect is that there's a big shift in terms of the flows of the industry that the mutual fund receives, which is significantly that large cap funds are seeing outflows, but mid and small cap funds and multi cap funds have seen a sharp increase in their inflows. So this dedicated mid cap money, the regulator says that if you get money in a mid cap fund, 65% has to go into mid cap. When you get money in a small cap fund, 60% has to go to small cap. So there is some automatic buying which has happened in the mid and small cap, as a result of which, because these investors tend to go by past returns, you're seeing that the folios today in small cap funds has overtaken the folios in large cap funds and in mid cap funds. It's almost doubled over the last year. So there's a lot of retail money flowing into a mid cap and into small cap funds, so much so the number of investors in small cap is now higher than either mid cap and large cap. Now, this has led to a rally and created a virtuous cycle because somebody puts in money, the price goes up, then somebody more puts in money, the price goes up. So the valuations have shot up because of the sudden interest in small cap and mid cap, which partly is because they've seen good past returns and hence investors are along with their distributors putting money. But bear in mind that this can't last forever. And because there are so many of these small investors who have come in, right? How far they are prepared to handle the volatility, the markets, and the actions, we have to wait and see. But definitely the small cap market is not cheap at this point of time because all eyes and orientation is towards small caps today, right? So from that point of view, the saving grace, however, for the small cap is that the increase in the SIP book from over 12,700 per month in August of last year to almost 16,000 crores in August of this year. The 1 year, if you've seen, they've grown up by almost 3,000 crores, which is a 25% rise. Most of this rise would appear to have come into the small cap and the mid cap segments, and hence fund managers would probably expect to get those installments every month for the next 12 months to 24 months to 36 months. So there will be some amount of buying for small caps and mid caps from the SIP flows. However, these flows, when FIIs pull out 15,000 crores is nothing. You saw that in the month of September, they pulled out 15,000. But you saw in the previous year when they pulled out money, if oil prices rose, they pulled out almost 200,000 crores. So this can provide a cushion. The inflows through SIPs into small and can provide a cushion to the bottom of the market, but it can't fully absorb the selling pressure from the FIIs. Because when the FIIs sell large caps, fund managers will be forced to liquidate the small and mid cap portion of their multi cap and flexi cap funds and buy those large caps which are now available reasonably. So this sale of stocks from the small and mid caps could add to the volatility. Hence, it's going to be a fairly volatile period for the broader market, right? And if you see, actually, lump sum flows in the industries have been coming down. It's only the SIP book which is making the industry net positive in terms of buying. Okay, and SIP flows today account for a third of the flows and a third of the AUM of the industry, right? So in this context, right, what are the risks involved? We are seeing that both mid and small cap are at about 12% premium to large caps. The large caps are trading at a long-term average from a historic perspective, but clearly with respect to emerging market and world market, we are trading at a fairly high premium. So anything that can make this premium come down is what we need to look at the risk. So first risk, of course, is the oil prices, which I explained clearly to you. And if you see in oil, the thing is that when oil demand is around 100 million barrels, non-OPEC countries supply 70. I've circled those. So the balance 30 odd million barrel demand, the OPEC actually behaves like a cartel and only supplies less than 30, 28 at that time, which makes the price go up. However, when oil demand collapses to even by 10% to 91, OPEC can't cut production beyond 25.7 million barrels. Hence, then oil price starts to fall. So this demand movement of oil is the key that we need to consider at this point in time. And if you see the US, which has strategic reserves of oil, which it uses to control the price of oil, has also used up a lot of its strategic reserves, which is now back to the lowest levels in 1985. Furthermore, OPEC is now predicting that this winter, that shortfall would widen from 1.8 in the quarter 3 to 3.3 million barrels per day. Clearly, there is going to be pressure on oil prices. And the latest news, which is not captured in the presentation of the war between the Hamas and Israel, is purportedly supported by Iran, and hence you could see potentially a trigger for oil prices to rise because of that. Iran is one of the big suppliers of oil to the world market. Right, and India's historic advantage vis-a-vis, because we're buying from Russia, that price has now come down very dramatically. We $83 versus $87 per barrel. So India no longer has a very significant cost advantage because of buying from Russia. Right. So in the meantime, one of the risks factors to evaluate is the world economy status on whether emerging markets will continue to get flows. So to quickly take you through that, overall outlook, the world, United States and Europe are all going to grow at what 1.5% per annum, but Central Asia, emerging Asia is going to grow at 3.5 to 5 per annum. So clearly, growth capital would tend to move away from advanced countries to emerging countries broadly as a thought process. Within this pool, if you see, the highest share of GDP growth increase, if you see, is going to be China, followed by India, right? And Fed has also revised its GDP growth projections from June to now to almost doubling for the current year from 1 to 2 to 1.5 for the next year. Hence, they are saying that they will have to keep interest rates higher for longer. From an earlier expectation, they would do a rate cut to 4.6 in 2024. They're now saying they will keep the rates at 5.1 probably in 2024. So you're going to have higher rates for longer, which is one issue on emerging market, because the costlier the money is, the less the flows that emerging markets can get. The US is also shown as fastest nominal GDP growth, partly driven by inflation, partly by the actual growth, real growth. And then if you see, because of this growth, the uncertainty around the US markets is easing. So the 3 month ahead macroeconomic uncertainty has come down significantly. If you see from July for 3 months ahead to 1 month ahead to 12 months ahead, right? So as a result of this, a soft landing in the US remains the consensus expectation. Nobody expects the US economy to slip into a recession, but to have a kind of softish landing. As a result of which, liquidity-wise, there's no concern. The US, which had brought down liquidity to some levels, has now pumped it back because of the banking crisis, right? World liquidity also is healthy at around $25 trillion. So from that point of view, if the US economy is a recovering mode, if interest rates continue high, flows into US Treasury will go up, setting the stage for a rise in the US dollar. So the green line here shows you the dollar index has started going up. So the dollar is appreciating. When the dollar is appreciating and interest rates are high, hedge funds don't want to bet against the dollar, especially when their borrowing costs also have gone up. So this will generally tend to lead to outflows from India and other emerging markets, right? So from that point of view, if you see, Saudi Arabia has also changed its stance. Now when oil prices go up, they're not taking that money and putting it outside markets. In fact, they've reduced their markets in US from 184 billion to 108 billion. So to some extent, the rise in the dollar would be countered by a selling by Saudi Arabia. At the same time, gold gives you a good indication. Over the last 6 months, gold has corrected about 9%, which is a good indication of the dollar strength. So when dollar strengthens, gold weakens. When dollar weakens, gold strengthens. So the scenario right now, because the rates of being higher for longer, is leading to a strengthening of the dollar, countered by certain other facts like US government borrowing is at an all-time high. Their interest payments every year, every single day is $5 billion. And their interest service is as high as their defense budget today. So the US is on a slightly, while growth seems strong, the risks around the economy are also going up. Interest rates on credit cards has gone up, but still usage of credit cards is also shot up. So we are in for a credit cycle which could see some challenges. So it's a mixed story around the US at this point. Well, GDP numbers, employment, all those seem to be showing well. The people are now beginning to get a bit concerned about equities, and they are moving out of equities into cash. So if you see now from a US market perspective, Morgan Stanley publishes a sentiment indicator which attempts to predict markets, and that is indicating that the markets are approaching a sell zone fairly quickly, and we have to wait and watch how it will behave, right? So then if you see, then the 1 month and the 3 month returns of the US stock market has already turned negative. The emerging market is also turned negative because of flows out. India remained the shining light there. So though from September there has been selling, from April to September, because there have been flows, you've seen that the Indian market has delivered the best return of 12.6, equal to some other US indices, right? So other emerging markets which have done well are, of course, Japan and Singapore and South Korea. So the reason to point out this is one of the things which could happen. You saw in the last 15 days of December, you saw 3,500 crores of selling. In the last 15 days of December this year, you could see a similar amount of selling because the market where they made the most returns in the emerging area seems to be India at 12.6. So a little bit of selling pressure because of profit booking would also be anticipated in the end of the coming quarter, right? And when you then look at it for a US-based fund manager, right, when the in same earnings yield that I compared with the Indian GSEC, again in comparison the US GSEC also, his returns from our market are very similar to what he's getting on fixed income from investing in the US. So that's again another thing which some funds look at and say, am I better off putting my money in the US treasuries? Right. And the other risk factor for India is the monsoon. And as you saw, even the September number which has come in as a largely deficient monsoon. So the impact on inflation and how that works is got to be evaluated as a risk factor, right? So those were the risks as far as Indian flows are concerned. You look at the positives now. The positive is that there's long term. You saw that sovereign wealth funds and pension and insurance funds putting in money wherever they see a country's growth is very good. So from India's perspective, if our growth continues good, the short-term hedge funds may take a call based on oil, but a long-term growth capital looks at the longer-term growth. So oil may come up and go down. Is it going to affect India's GDP growth that much? That's what we'll see. And this money does not change very easily. So if you now look at the growth, clearly India at around 6% is much faster, double the rate of growth of the world, and much faster than the advanced countries. Second is, we are the fifth largest economy now, and we are progressing higher. The number of factors around which Indian economy has improved its parameters from 2014 to 2022, which augurs well for a good economic growth, right? So some of those are listed in the slides here. And now when you look at the infra progress that the government has done, the fact that we have overtaken China now in population, and we will further increase the gap with China over the next 20, 30, 40 years. That China continues to decline, but India has a very slow rise and a decline. And China's growth is also starting to suffer now because of the fact that COVID was there, their geopolitical tension between America and China are there, China's cost of labor is high, and that labor is declining, because of which now you see a significant proportion of people from the US are trying to shift their production away from China. And then when you see now already this action is put into place, you can see US has increased its imports from Mexico and from Canada and dropped drastically its import from China, right? In fact, if you see, they are going in opposite directions, the Mexican imports versus the Chinese imports. So clearly there's a lot of issue around the Chinese being able to sustain their high rate of growth purely dependent on a American situation, right? So China's exports, in fact, to across the world has dropped dramatically except to Russia. This could work to India's advantage because India has among the lowest manufacturing labor costs in the world, as you can see from this graph. And further, we and Vietnam are most likely to benefit from a shift out of China on a whole host of things provided in this table, right? Our cost competitiveness is improving, and a lot of MNCs taking advantage of the PLI schemes have already set up base in India. And if you see, that's one of the main sectors involved is the mobile handsets, where you can see the sharp increase in the mobile handset exports. And today, we have managed to snatch 6% share from China, whose share has dropped from 72 to 64 on smartphone production. A further list of MNCs that are expected to start operations in China means that FDI flows into India will remain strong and stable and lead to all of these drivers for Indian growth in the medium term, right? So based on which, if you see, right, India's potential growth till next year can be about 5.8 to 6.3, but over a longer term, we can expect it to touch close to 8, maybe even double digits. Right? As a result, from an average 3% share of world GDP, India is slated by 2027 to sharply increase that to 4% share of global GDP. So this could naturally lead to inflows from sovereign wealth funds and long-term money for whom this is a great parameter to allocate capital. So we can reasonably expect by 2028 that the growth of the Indian economy would take it above Germany and Japan and make it the third largest country by 2028. Right? As a result of this consistent growth story, India, in terms of the riskiness of the country is moved down much lesser now. So we are now more of a defensive stock, if I may say, compared to other emerging market countries. And hence that will lead to far more sustainable flows, because those kind of stocks tend to get a further reduction than a risky cyclical stock, right? Which many other commodity oriented emerging markets are actually, right? And then in the medium term positives to sustain it, because when you as an investor or as a distributor planning your customers investment, you want to look at, yes, in the short run, I know there is the risk, there are these positives, they'll balance each other. But what about the medium term? What are the factors? So while we can't predict FII flows other than the growth flows, as long as India's growth story remains constant, we can to some extent anticipate a greater growth in domestic flows. So what is the outlook of that? The domestic growth, the fact is our per capita share of the world in GDP terms is going up. This means that what? From where we are at $2,300 today, we expect to double to $4,700 by next end of the decade. Now, this doubling, previous time when a doubling happened between 2012 and 22, you saw that bank deposits grew 3 times while per capita income doubled. Why is this? Because as a thing, household financial assets in India are very, very low. And the scope for that to increase will happen only as your base earnings goes beyond spending on necessities and into investments and higher end consumption, right? Further, India's age means that the age dependency ratio, that is the people who are dependent on the people who are working. So generally you can take it that a person works between the age of 20 to the age of 60, right? So age dependency tells you those below 20 and above 60 are dependent on those people in this. There, India's age dependency is coming down, which means what? We have far more people working, far less people depending on them. So when you have lesser dependence, you have more money to save and to spend, right? So this is again augurs well for a future savings come consumption story. Further, what's happened over the last 5 decades is that this per capita income growth is tilted heavily towards the richer part of the population. The rich are getting richer and the poor are getting smaller in terms of their allocation. So in the year 1961, for example, the top 1% of the wealth of the country was with 11.9% of the population. And the bottom 50% was 12%. Today, the top 1% is 42% of the country's wealth. And the bottom 50% is only 2.8. Now, while this looks like a very, very disparaging statistic on the fact that the gulf between the rich and the poor is widening, but it also says that this set of 42% of the people who are in the top 1% or the 75% in the top 10% are going to have much more disposable incomes after meeting their expenditures in their hand to either save or to consume on luxury goods. So as a result of which, if you see that an allocation of household financial assets, right, into physical assets like real estate and gold versus financial assets like bank deposits, savings, and mutual funds, that has tilted decisively in favor of financial. It was at 45 financial, 55 physical in 2014. Today it has reversed to 60 financial and 40 physical. So clearly the wealth growth of the nation is reflecting in a greater financial investment, partly supported by what is called as a moderate inflation. When the inflation is rising, people tend to put more in physical assets. They feel protection from there. And when the inflation is falling, they tend to shift to domestic assets. So as a result, if you see in this graph, though 60% is financial, the share of mutual funds is only 2%. Though we have mutual fund industry has also grown at 23% per annum, the share of it is very, very minuscule, 2%. So the scope now in the future, as per capita income doubles and people's disposable incomes goes up, right? Yes, discretionary consumption will also go up, but savings can also go up more than the 3 times which the previous doubling of per capita showed, to maybe 4 times or even 5 times. So as a result of which, if you see the long way to go for Indian mutual fund industry, because only 12% of the MF assets as a share of GDP compared to 120% in the US and much higher in other parts of the world, right? So as a result, you're seeing this action already make traction on bank deposits, right? Where from a 13.7% share of bank deposits, today MF assets are at 22, and this is actually to rise even more. As a result of which, and the stock market has now decisively been gradually dominated by individuals versus corporates. So if you see from a 45% retail share, individual share of assets has gone up to 60%. All this augurs well for a consistent flow of money into mutual funds to support the stock market. And there's a long way to go. This is the city-wise penetration of equities itself as an asset class. Other than Gujarat and in Bombay, it's not in Bombay and in Maharashtra, it's not in double digit anywhere. And there is a huge potential for this to grow. And we expect that that will do a lot of help there. And of course, people tend to then say that what about real estate? Yes, higher disposable income will mean you're seeing a strong growth in sale of flats, especially of the higher end flats. And but then remember that over the long run, right, real estate has just delivered high single digit returns, whereas the stock market has delivered strong double digit returns, right? This you can see over various time frames. And hence, now moving to the markets from a short term outlook, we pointed out certain risks. And then when you look at it, the risk is that the market has taken on a very high 21% growth in the large cap for the next year. Now, in the next few months, as the festival season comes through and various factors play out, this expectation could be going up and down. So the risk factors around that are that if the expectation drops to 20%, the growth of the EPS for the following year, you could see a 20% downfall in the stock market. However, if there's even a small improvement in the thing to 25%, you could see the stock markets hit 80,000. So the market is very finely edged in terms of the expectations. A lot of the good news in the economy has been discounted. And if that good news comes, we'll see a 5% growth in the Sensex by December. But if the good news is even slightly better, it could go up to 80,000, or if it's slightly worse, it go to 52. So the market is in a very sensitive state, is what I wanted to tell you, right? And generally be aware that lifetime highs have generally led to corrections, right? So these are the dark lines are the lifetime highs of the market in the previous few years. And then when you see the drawdowns have happened anywhere between 60% to 10 to 15%, and an average around 30%. But the point of reassurance that I want to tell you is that if you're a longer term investor and you stay for 5 years or even 3 years, you will see that more than half of the time you will get inflation beating returns from the stock market. So on that point of view, I wanted to take a call to stay. And from a medium term outlook, if you look, this stock market follows the earnings over a medium term. But on a year-on-year basis, there could be fast divergence between what you see as EPS growth and what you see as stock market returns. I have circled there the calendar year 20, where there was a negative growth in the EPS, but a 15% growth in the stock market, right? So you could have the opposite scenario also when you go 2 years before, when there was a 21% growth in the EPS, but only a 3% growth in the stock market. So in a year-on-year, it doesn't actually, the EPS growth doesn't match directly with your stock market returns, but it smoothens out over a period of time. So hence, if you look at it, right, from an Indian market perspective, we feel that we are at the beginning of a bull cycle where corporate profits to GDP, which had dropped during COVID to as low as 1% of GDP, have now reached 4%. And the previous peak at 2003 to 8, it had reached 8%. So we are on the path to reach that. When that happens, then when you see over the medium-term perspective, the return on equity of stock market companies, the Nifty is actually in a value creation zone after a decade. So this augurs well that the return on equity, which is hovering at around 17%, could head high to 26% by 2023, 24, 25, and then you could see the rise in the markets. And in fact, if you see, the various parameters of the market from a medium-term perspective are ideally suited to the period 2003 to 8, when we saw the Sensex go from a 2,900 to 21,000. We can see that a lot of the parameters show that the stock market is similarly there at the beginning of a bull economic cycle, which will lead to ultimately returns from the stock market, right? So over a period of time, if you see, the country's nominal GDP is reflected in the stock market, in fact, with a slightly better return. return. So in India, if you take a 15-year CAGR against the 8% nominal GDP, we have shown almost a 10% stock market return. Similar in the case of China, it's 13 versus 18, and South Korea 3.5 versus 7. So I think for a medium-term investor, you can look at this and feel that the longer term growth of the economy will be reflected by a better than nominal GDP growth in the stock market, which you all should benefit from. And hence, at this point of time, from an investor perspective, a domestic oriented, broader cap curve across large, mid, and small caps is better, because when you see that you saw that the large cap is now trading at a discount to the mid cap and the small cap. But if you see where in the cycle you are, if you are in a good economic cycle, which is the bottom table, versus a bad economic cycle, which is the topmost table, you will see that in a bad cycle, the large caps tend to deliver a better return than mid caps, and a better, or rather, if you say a lesser loss than mid caps, and they are a lesser loss than small cap. But when you come to a good economic cycle, you will see that the small caps always deliver a return better than the mid caps, which in turn deliver a return better than the large caps. Where are we in the economic cycle today? You're already seeing right from the bottom of COVID to 30th September, we have now reached a stage where clearly we are in a good economic cycle, with the small caps delivering 50% returns, mid caps 40, and large caps 30. But from an economic cycle, we are just at the beginning of the cycle. Hence, over the next decade, you'll see India moving from a bottom cycle, early cycle, to the up cycle, then to the expansionary cycle, reaching the peak, which will then follow through with a late cycle. So you're seeing a clear 7 to 10-year pathway for an economic growth, which will lead to a generally bullish stock market, right? And so for your allocation at this time, I would suggest that given the short-term risks involved in the market, with the oil prices rising, with US interest rates rising, with the dollar strengthening, and all of those situations, large caps would face a little of pressure, but mutual fund managers have adequate money to buy those large caps and support them. Whereas that money would tend to get pulled out of mid and small caps, which are at higher valuations today. So you could see a higher degree of volatility in mid and small caps compared to large caps. Hence, from a one-year perspective, I would recommend that the portfolio in large caps would see a better risk-reward return and lesser volatility than a mid-cap and a small cap. Hence, a 70-20-10, which is the ideal one that reflects in a flexi-cap fund or a large and mid-cap fund, to be the best place to allocate. However, if you are more risk-averse, then of course you have the aggressive hybrid balance advantage and equity savings as categories, where a mix of debt and equity reduces your volatility, giving up a little bit of the return, but still better from a risk-reward perspective for a more conservative investor, right? So thank you very, very much. With that, I end my speech for today, and look forward to interacting with you all in the next E.M.I.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.